It's another business week. Good morning and welcome to Business Morning. I'm Chimeze Obi Iwago. Barely recovering from the 2016 economic recession, the Nigerian economy slipped into its second recession in 5 years as the economy contracted in the second quarter of 2020 and, of course, third quarter of 2020 by 6.1% and 3.6% each year on year. Now, while this was caused by the severe damage brought by COVID-19 due to movement restrictions, the continued reliance on oil for FX receipts and government revenues, together with poor investment in the healthcare sector, weakened the resilience of the economy. AfriInvest West Africa, one of the leading investment banking firms, in its annual banking sector report for 2020, reviewed the performance of the banking sector, presents the firm's opinion on the direction of the banking sector over the short and long term, while highlighting key risks that could affect performance. In the report, AfriInvest Research explored the wide-reaching implications of poverty on the level of insecurity in the country, stressing the need for improved economic development. The report is titled, "The Insecurity Challenges of Poverty." And joining me now is the Group Managing Director, AfriInvest West Africa, Ike Chuki. Thank you very much, Mr. Chuki, for joining us on the program. It's always a pleasure having you on the program.
Good morning, Chimeze. Delighted to be here.
Good morning. Well, the insecurity challenges of poverty, that's the title of your banking sector report for this year. Why? I would have thought it would have been all about COVID-19 and perhaps its impact on the banking sector.
Thank you for that. I think that when we look at all the issues that happen around COVID-19, yes, they are important and they're relevant and have caused problems for Nigeria, indeed for the rest of the world. But we also have to recognize that that we have to look at our own problems from our own perspective. Earlier this year, the Nigerian Bureau of Statistics released a report showing that the poverty rate in Nigeria is elevated at 40.1%. This means about 83 million people are very poor. We believe that in an environment with an elevated poverty level such as this, there are huge difficulties that it presents because it becomes a breeding ground for insecurity. And you see wide-scale issues of insecurity across all regions of the country, which is, I think, has actually reached a tipping point. The aftermath of the chaos and destruction that came from the NSAS protest is one example. So that's why we felt it was appropriate to title the report with the insecurity challenges of poverty.
Talking about widespread insecurity, what are these risks? Well, insecurity risks, and their impacts not just on the wider economy, but of course on the banking sector in general.
Yes, I mean, we're all very much aware of the Boko Haram insurgency that continues to rage in the Northeast. The cattle rustling and killings in the Northwest is prevalent. Every other day we hear stories about, incidents there. Header farmer clashes across middle belt of Nigeria. There have been risks of attacks on our oil infrastructure from the south, and kidnappings and robberies are all over the country, as you can see. So this is why it's become quite an issue for anybody looking at investing in Nigeria, starting with domestic investors, before even think about foreigners. Their biggest issue now is, am I secure? I mean, imagine thinking of setting up a large, farming plantation, taking any cash crop. You can think about, oil palm or rice. And your first concern will be, are your people going to be safe? So with this sort of, widespread insecurity, it has impact on investments, on growth, and on job creation, which then further, if those ones are constrained, then further sort of catalyzes more poverty and then leads on to more insecurity. Yeah.
Now, the report stresses the need for improved economic development. How would you rate the fiscal and monetary responses to this crisis so far?
We have seen a muted response, I think, in a way that you saw that the fiscal response was something like 500 billion naira. That is small because it only represents 0.4% of GDP compared to, say, South Africa, where they did almost 7% of GDP. The response in itself, from a fiscal point of view, was not sufficient. There are only 1.2 million people have been registered in the social register. Meanwhile, we have, at least based on the government records, 20 million households that are considered poor. So that is small. From the monetary side, you recall that the CBN had announced intervention funds of 50 billion for household and SMEs, 100 billion for healthcare sector, and 1 trillion for manufacturing sector. Yes, those were the announcements, but we felt that the intervention to households and SMEs is quite tiny, compared to the size of the Nigerian GDP. And you know that SMEs represent the largest size of employment within the Nigerian economy. Elsewhere, if you look at disbursements that have been happening to the healthcare sector and the manufacturing sector, it's been quite slow. And other things like the issues around the foreign exchange environment, the devaluation of the official currency, trade problems are also actually hurting those same people in healthcare and in manufacturing. So I would say at best, the response from the fiscal and monetary side has been muted.
Now, you have frequently mentioned structural reforms that are lacking, but in the past year, we have seen some progress. Which of these reforms inspire confidence, and what more do you think should be done?
Yes, it's quite encouraging. I think we saw the government has come out with the increase in VAT, and also measures in the Finance Act to simplify tax payments and reduce the cost of compliance. Those are all very well and good. Also, we've seen the removal of petroleum subsidies and the adjustment of electricity tariffs, which will help the government to retain more of its revenues rather than having to use that to subsidize consumption. All very well and good. But the problem we see is that while we recognize that our revenues are going down, our costs, particularly our recurrent expenditure, has not been going down. Indeed, on the other hand, it's been going up astronomically. We see that when you adjust the government budget for the actual revenue earned and not the revenue they are projecting in any particular year. Take 2020, for example. The recurrent expenditure of government is now about 120% of their actual revenue. That means the government is spending much more than they've earned to maintain themselves before you then talk about putting money for investments in capital expenditure around the country. And that is really a really worrying sign. So something needs to be done about that. And for government to do that kind of expenditure, they are going around borrowing. And then when you actually adjust the debt service to revenue, again, based on actual revenue, we're now coming to about 85% debt service to revenue. Again, very, very troublesome. So there's need for serious improvement in areas like, building stronger institutions, human capital development areas, education and healthcare. Of course, oil and gas sector reforms, we've been waiting for that for ages, and more reforms in the power sector. Transportation is in dire need of support, and anything that we can do to boost competitiveness, which is really removing more government interference in the way business is done. But last but not the least, probably the most important today is security. What we are doing about security in the country that has serious implications for the journey.
Now, I would love you to share your insights on the performance of the banking sector in 2020. The past 1 year has been eventful for banks, as we saw a number of directives from the CBN, especially around credit creation. Now, what are your expectations for profitability in the sector in 2020?
We are expecting that profits will be kind of flat this year for the banks. As a universe of what we've been seeing, we saw that as at half year 2020, Tier 1 banks had expanded their gross earnings by 2.2 trillion naira, just a 5.5% growth. Tier 2 banks have seen their own gross earnings go to 540 billion naira, just 4% growth. So there's weakness in the growth of gross earnings, and this is due, potentially, partly due to the low interest rate environment. Obviously, the directive by CBN to force banks to expand their loan books has helped in credit creation. We've seen credit grow by 7.4% this year. And again, when compared to last year, that is helpful. But the low interest rate environment, CBN has also affected the banks, particularly from a net interest income perspective. Savings deposits now, banks are allowed to pay only 10% of MPR on savings against the 30% of MPR they used to pay. So that has, helped to increase their net interest income. But on the cost side, we see efficiency issues. Tier 2 banks have seen an improvement in average cost-to-income ratio. They're down to 71% from 74%. But Tier 1 banks have suffered a deterioration. And we see that trending worrying 62% from about 61% last year. So all of these things are coming to the year thinking that the banks have contributed this year, profitability will be challenged. And if it keeps flat at the numbers for 2019, then in real terms, they've lost money because the exchange rate has moved from official rate of 305 in 2019 to now about 390 in 2020.
Now, one of the most significant policies of the CBN last year is the introduction of a minimum loan-to-deposit ratio of about 65%. 1 year later, how will you measure the impact of this policy?
It is helpful, but also it's also a complicated policy. On one hand, we're in the middle of a recession. We're suffering the aftermath of COVID-19 and its implications for businesses. So, this is a much more difficult environment even for businesses that have weathered the storm of the pandemic to grow. But on the other hand, you have a policy from the apex regulator insisting that you expand credit to the real sector. So banks have complied. We've seen credit expansion has happened. The current amount of credit in the whole economy is about 59 trillion. But this has also had an effect because there's much more weakness in the liquidity ratio of banks. Tier 1 banks, I think their liquidity ratio fall from 46% to 43%. But the average loan-to-deposit ratio for all the banks have also improved. So there's more credit. The only problem we have to see is that by next year, you may see more non-performing loans coming out. And then this will also create problems for the banks, right? Those loans, even in a difficult macroeconomic environment, such as.
Now, one of the major issues for banks have been around maintaining asset quality. How healthy is the loan book of banks?
That's a good point. We see the NPL ratio, non-performing loan ratio, has become elevated. It's now at 6.5%. The industry threshold is 5%. But Tier 2 banks are low at 4.5%. The Tier 1 banks are the ones that are above it. We suspect that the regulatory forbearance and COVID-19 is part of the primary driver of stability in NPLs. We worry that banks have to be cautious in lending, but at the same time, they have to comply with the central bank. So I think that the bigger issue is that if you want to unlock credit opportunity in the country, you really need to think of how you improve the overall macroeconomic environment. And you have to continue to improve on the ease of doing business because those have bigger implications to companies than just the cost of loans, to them. And so we need to kind of take all of this into perspective. But yes, NPL ratios are elevated today, and for the Tier 1 banks, they are above the CBN benchmark of 5% at the uppermost.
Now, across the world, we have seen capital adequacy for banks come under pressure amid COVID-19, with some countries mandating the suspension of dividend payments to support capital levels. How are Nigerian banks positioned?
I think Nigerian banks are doing well. They've remained resilient. Profitability, like I said, is positive. They're tracking on profit, although they are going to be flat relative to 2019. Indeed, the CBN has also put in measures, in place for capital accumulation for the banks that are struggling. So that is one. But Tier 1 banks, we see average capital adequacy ratio of 19.5% as of half year this year. Tier 2 banks are at 17.5% as of half year this year. Both groups are above the minimum requirement of 10% for national banks and 15% for international banks. So, national, that's national banks with national licenses and 15% for banks with international licenses. So, indeed, our Nigerian banks are doing quite well in terms of having sufficient capital to do their business.
So, what can you say about the current valuation of Nigerian banks?
Well, that's a good question. You know that the markets have rallied consistently since about March, April this year. And I think year to date, Nigerian capital market is up about 30%. And some people have been asking me a question as, is the market overvalued? The interesting thing is that when actually you break it down and look at things like book price to book ratio, you see that Nigerian banks remain relatively undervalued. We are currently at 0.5 times price to book value compared to the African and BRICS peers. African comparable banks are 1.2 times price to book ratio, and the BRICS are also at 1.2 times. So yes, Nigerian banks have enjoyed a recent renaissance in terms of the market this year. And I think the low yield environment has also been so Nigerian banks did have good valuation comparisons when you look at them overall and stepping outside of Nigeria itself.
Okay, Nigeria is not alone in a recession. In fact, the global economy is in recession. Now, the Nigerian government is optimistic this recession will not last beyond first quarter of next year. Do you share the same optimism? What's your own projection?
Yeah, interestingly, we saw that the IMF in their half-year numbers were projecting minus 4.3% contraction for Nigeria in 2020. We have reviewed that in the context of the statistics that has been published since September this year. And our own estimate is something like minus 2.9% contraction. We're projecting into next year that the economy should be up 2.5% positive growth. So that shows you that we have managed to kind of take the punch from COVID-19 much better than expected. And yeah, we're in alignment with the government to say that we should see positive trajectory throughout 2021, particularly as you know that the fact that there's a vaccine exists for COVID-19 will mean that Western economies will begin to, recover more quickly. We continue to introduce more loosening, all these lockdowns as a result of COVID-19. Once the economy begins to move more to normalcy, then that would also help to propel the Nigerian economy. So we are constructive that we should see a recovery, just like the government is predicted in Q1 and Q2 next year.
Okay, so what about the banking sector? What is your outlook?
Our outlook, like I said, this year we think it's going to remain flat. Into next year, we think that they would also, being a barometer to the rest of the economy, we'll begin to see a quick recovery as well. Already you can see the last quarter of the year, the Nigerian economy is picking up. We think that we might actually end this quarter somewhat flat from a GDP growth point of view. So, but the banks would always have that information ahead of most industries, and so they would have felt that impact. So we think next year will be much more positive for Nigerian banks. But the issues as to the context of the industry remain. There are now 28 banks across different tiers, from the internationally licensed banks to nationals, to merchant banks, to regional banks, and to even the specialized banks. And so there's more competition. And you also have to remember that the fintechs are not resting on their laurels, and the fintechs are also attacking the same space that Nigerian banks are operating in. So making it further more challenging for everyone. But we think on balance that the big players will survive.
We hope for the best. Ike Chioke, Group Managing Director, AfriInvest, West Africa. Thank you very much for your time. We do appreciate it.
Always a pleasure. Thank you, Chimezi.
And better days ahead for the electricity sector as the DISCOs and the federal government now sing from same page. Find out how as I speak with one of the directors at Eco DISCOs, George Etomi, next. Over the years, the DISCOs have lamented the challenges they as electricity distributors face in the power sector. But today, the tone of the music is changing as the government seems determined to reset the electricity supply sector. One of the directors at a co-distribution company, Mr. George Etomi, joins us now to tell us how things have been changing for DISCOs and the sector in general. Good morning, Mr. Etomi. Thank you very much for joining us. It's always a pleasure to have you on the show.
My pleasure, Chimeze. Good morning.
Good morning. Well, it's good to know that the discos and the government are now talking and agreeing on the way forward towards achieving constant power supply, contrary to what was the case before. What changed the narrative?
I believe what changed the narrative is the realization by all the affected parties that the quicker we all sat around the table to dispassionately look at the problems affecting the entire value chain, the better it will be for every one of us. And let's be straightforward with this. The twin devastating effects of the COVID and the crash in the oil prices has sort of brought some realization down home that basic things like ensuring that there's constant electricity as a means to navigate our way out of the recession that has come upon us is very important. So most of the grandstanding that used to be there has disappeared. And in fairness to all the members, the federal government, starting from the presidency, the central bank, the Ministry of Finance, the bulk trader, that's NBEF, TCN, the regulator, NERC, the banks, because they're also major stakeholders, are all sitting together. We're having regular meetings, and the aim of this is to ensure we maintain an alignment in the entire value chain. So the discussions have actually gone it's looking at what we can do to boost the distribution network, transmission network. We want greater transparency with what happens at the supply end, which is the generating of the PPAs that we have for generating power, and then the gas supply. Now, with everybody on the table, it's then easy, and it's easy and in fairness that's acting like the umpire, because they are a little removed from, let me say, the politics of power. So they're able to look at straightforward economic principles that attend to the sector. And it started with a little bit of roughing up, smoothing out the rough edges. But I can confidently tell you that we're now at a point where over 80% of the major problems have been identified. And then we're now beginning to methodically deal with them one after the other. And I can tell you again that this slow achievement of a realignment in the entire value chain is the reason you find this change, like you put it, in a different tune is being said right now. And it's a good development for everybody.
Mr. Tommy, now, over the years, discos have clamored for cost-reflective tariff. Now, you have it. However, it is called service-reflective tariff instead. How has that played out so far?
Well, you are right. When the privatization came on, it was predicated on the fact that there would be cost-reflective tariffs. In other words, the cost of the product should be the minimum reflect in the tariffs. But this was never attained for various reasons. But I think, as I told you, with time passing and with the perfect economic storm we find ourselves, the federal government is no longer able to inefficiently, as it were, bear the subsidy in the sector. So they've now agreed to, as you correctly put it, service-reflective tariffs. And it's a question of semantics, but the major difference is that with service-reflective tariffs, discos are now going to guarantee consumers a minimum of a certain number of hours of supply, depending on the consumption band they find themselves in. And that will now form a contract between the consumer and the distribution company. For example, the regulator has set out 5 bands, bands A to E. Band A will include customers who would be guaranteed a minimum of 20 hours of supply a day. Band B will be a minimum of 16 hours. Band C will be a minimum of 12 hours. Band D, a minimum of 8. And Band E a minimum of 4 hours. Now, depending on which band you fall under, your tariff is set, and naturally it's high for those who get the most power. However, following the discussions between Labour and the federal government, the regulators agreed to a tariff freeze for bands D and E, who are considered the most vulnerable in the consumer chain, and concentrated on bands A to C, so that most of the supply that comes in goes towards ensuring that you now meet those contractual requirements. Because if you don't, then you'll be liable to any consumer who feels so shortchanged. Now, to make that possible, steady electricity does not depend on the distribution companies alone. Distribution companies will only distribute what they get. So it comes into play that the TCN, which is a transmission company, is itself made to align with the service reflective tariffs by themselves guaranteeing that they would reduce or take actions to reduce the frequent grid collapses we have, so that discos can have power to supply. Now, this is reflected in a service level agreement between the transmission company and the distribution company, so that if a customer holds me liable for not giving him power, and I'm able to prove that my inability to do so is because the TCN failed me, then any recourse against me, I can get some satisfaction from the transmission company. Now, the transmission company itself is saying, fair enough. It is not every time there's a grid collapse that it's my fault. If I don't have gas, my grid will not have power, or not enough power, and the grid can collapse. So me too, I want some assurance from gas producers that I will get gas. So you can see this alignment that I'm talking about. Before, the value chain was not speaking to itself, but now everybody is beginning to align themselves, because we now have what I call a contract-based market. And let's face it, I'm sure you agree with me, consumers are ever more aware of their rights, and many of them are beginning to sue for damages they receive from this sort of inefficiency that has plagued this value chain. And it is the right thing to do. It is the right way to go. And the results, in my opinion, will begin to reflect very soon.
Yeah, you talked about the various bands, band A, B, C, who are, of course, going to be paying now. The D and E, I mean, there's a freeze on that. Now, one major concern of consumers, whether A, B, C, have been making sure that they are billed what they consume. And you, Discos, had oftentimes argued that it is difficult to meter everyone. And, for you to bill appropriately, you have to have meter. Now, the federal government had announced mass metering programs. Where are we in the implementation of this mass metering, and what are the Discos doing? What's their part in all of this?
Thank you, Chimeze, for that question, because metering is a major plank in this reset that's going on in the Nigerian electricity supply industry. And again, if you go back to the old arguments, the inability of discos to meter everyone was a function of the tariffs. But now the tariffs have been fixed through these discussions that are now going on. And that's how the central bank has been so key to these negotiations. They're now going to make loans available to the discos, which will give them access to funding that they require at very good rates, so that they can now deploy meters in a mass fashion across the value chain. Now, I think we've identified close to 7 million gap as the gap in the metering schedule. But as you can naturally expect, you can't get all 7 million at once. So what has been done is even the metering has been broken down into phases. Phase 0 involves 1 million meters that are already available in country. which were not deployed for various reasons, principal of which was the fact that most of those meters arrived at the ports and they were then subjected to some sort of 35% custom duty. Federal government has very graciously taken that off so that these meters can then become more affordable. So there's 1 million meters available instantly. It's already been distributed among the various distribution companies. And in fact, that program has kicked off with Lagos, Kaduna, Kano, leading the way for the mass metering project. And this will continue steadily. Besides, the metering program also comes with some support to meter manufacturers in Nigeria, because there are those who've already invested in the sector, and the idea is that whatever we do as a people or as a government will be to also encourage local, ultimately local meter. So the next set of meters that will be coming in as complete parts or would have more value added locally. And so it will progress. So we are going to achieve the twin effect of not only mass metering people, but also encouraging meter manufacturing. Again, if you ask me, it's a positive direction for NESI. And I believe it will deal once and for all with this metering gap.
Yeah. Now, the federal government had signed an agreement with Siemens for implementation of roadmap to, resolve challenges of electricity in Nigeria. How has that played out with the discos?
Well, the Siemens initiative is, I believe, part of the overall plan by the federal government to deal once and for all with the challenges in the supply industry. And like it was unveiled to every one of us, the first phase would deal with strengthening transmission and the distribution networks. The federal government has set up an SPV that's made up, I believe, of the Minister of Power, Finance, there is Minister of Works, the Attorney General, the BP, that would take, as it were, charge of this entire transactions emanating from Siemens, because these will need to be channeled through this agency or body or SPV that will then interface with all members of the value chain. Now, without prejudice to what I have said before regarding the reset in the entire NESI, once the Siemens transaction kicks in, it will come in as a major support so that we do not lose traction, we do not lose speed, because the things that will guarantee uninterrupted, and the emphasis is on the word uninterrupted supply, would a lot more detailed than I have explained to you earlier on. And that's why, hopefully, when the Siemens transaction comes in, you would deal with all the hiccups on the transmission side and on the distribution side. On the distribution side, most of the Nigerian network are old. So we really need to modernize them. And I'm sure, talking about modernization, you must have been privy to what happened about 10 days ago when Disco unveiled a supervisory control and data acquisition equipment, which enables you get a bird's eye view of what's happening in your entire network without having to send your cars all over the place. From one control unit, you're able to see what is happening across your value chain. We've done within that place, segmented our market so that those areas where we are contractually liable, we ensure that we monitor what is going on. This is the direction in which the entire industry should be going. We should be getting things modernized. We inherited a, let me say, manually driven outfit. So this time we need to convert it, and I guess that's what the private sector brings to the table. So Siemens will add to this on both the transmission and the distribution sides. On the transmission side, I'm sure again in the last 1 week, you've noticed we've gone through these grid collapses. And even as I speak to you now, there's a massive load shedding going on across the country. This is not where we want to be at all. we need to get to that point where once power is generated and sent for transmission, it is available to be given to the consumer. There's too much of, you get 4 hours a day, 6 hours a day. I get consumers who call me complaining and wondering why at certain time on the dot their electricity goes up. They're willing to pay. So there's really no point saying all this is saying, and people still have to depend on diesel or petrol to supplement their power supply. It's going to be a slow but steady journey. I think finally we've gotten the game right, and hopefully with the support of Nigerians, we can get to the promise. Now, talking about support from Nigerians, the support comes in the form of regularly paying your bill. Because again, power theft is a big threat to the entire industry. Some habitually refuse to pay and will invest in bypassing their meters. We have very strong directives from the regulator that any consumer who refuses to be metered should be disconnected. And anybody who bypasses the meter will be greeted with a very severe sanction.
Thank you very much, Mr. Tommy. Well, let's hope we eventually get it right. We will pay. We consumers, we will pay. Thank you very much for your time. We will pay. Let's have the light. Yeah. Okay. Thank you very much, Mr. Tommy. Yes. All right. Thank you. We appreciate your time. All right, let's look at the markets. The equities market managed to eke out a weekly gain amidst profit-taking pressure. And I'm glad Eddie is back to give us the full analysis. Eddie, I'm glad you are back and well. I missed you, by the way.
Jimmy, I missed you too, and I actually miss giving this analysis. Now, although I haven't been here, I managed to follow the development in the market from time to time, and just like you pointed out, the market, managed to push out some gains last week, although that was much lower compared to the previous week. Now, interest in Airtel Africa also played a huge role in offsetting the declines we would have seen in the market last week, as that stock was up by almost 20%. Week on week. Now, the all-share index was up 0.72% to 35,137.99 points, with the equity cap at 18.365 trillion naira. Now, we saw about 1.67 billion units worth 25 billion naira traded in 23,000 deals. Now, look at the sector chart. It was mixed. But before we go on with this, let's talk to David Adonri, a stockbroker at High Cap Securities. Good morning, Mr. Adonri. Thank you for joining us on the program. Well, I guess we just lost Mr. Adonri there. Now, as we can see, the sector chart was mixed. The banking sector was down 3.13%. Now, we saw declines from GT Bank and Zenith Bank. GT Bank was down by about 5%, while Zenith Bank lost over 2%. Consumer goods was down 2.78%, and that was due to the over 7% decline in Nigerian breweries. Industrial goods was down. Now, we saw declines from Dangote Cement and Boa Cement. Dangote Cement was down about 2.9%, while Boa Cement was down 1.8%. Now, we saw gains from insurance. Insurance was up 1.56%, while oil and gas was up 1.71%. I hear Mr. Adonri. Oh, okay, he's not there with us. Let's look at the unlisted securities market. Now, although we saw gains from the equities market, that segment of the market was down 1.43% at 719.53 points, while the market cap was at 534.83 billion naira. Now, we saw just about 1.46 million units worth for 347.96 million naira, all traded in 33 deals. Now, the year is, the year is winding down. And, investors are wrapping up their portfolio and their investments for the year. So we're either likely to see more profit taking or more bargain hunting before the year winds down. Chimi.
Well, I see more bargain hunting there. And I'm sure because Christmas is approaching, a lot of people will want to take quick profit and again, come back. So I'm expecting, like I always say, Santa to come. I always look forward to that. All right, let's see what happens eventually. For now, we'll take a break, and when we come back, we'll talk to Simon in London. All right, we kick off this segment in London with Simon. Good morning, Simon. Beautiful week to you. Good to see you. Well, starting off with Brexit, how did the weekend Brexit talk go? Any hope for a deal?
On Syria 19 of today's program,
said that Britain and the EU had made significant progress on the rights of European fleets to fish in UK waters and that a compromise on access to UK fishing waters was starting to emerge. But today, Michel Barnier, the EU's chief negotiator, denied that was the case, and the UK government also poured cold water on much progress there. And today, UK officials are warning that Brexit talks could collapse in hours unless there is progress later. That has led to the pound extending its losses this morning, dropping to 0.7% down. Nonetheless, the UK's chief Brexit negotiator, Lord Frost, will continue talks with his EU counterpart, Michel Barnier. Lots of people focusing on a call between Boris Johnson and Ursula von der Leyen later tonight, which is seen as a make or break moment as to how things are going to progress over the next few days. So stay tuned. We'll no doubt keep you up to date on those talks as they continue.
Absolutely. Well, it was the first weekend since stores in England reopened on Wednesday last week, and shoppers flocked to high streets and shopping malls, but in numbers well below pre-pandemic levels. Just wondering if you did go out to shop as well, Simon.
I didn't go shopping myself, but yeah, I do live centrally in London, and there were a lot of people out and about. A really stark contrast, as you say, to lockdown that we've seen over the last month or so. Saturday was the first non-working day since countrywide restrictions were eased, and it's hoped around £10 billion was spent by British shoppers over the weekend. London's West End attracted an estimated 300,000 people. However, on average, shopper numbers were a quarter below 2019 levels. That's according to a market research firm. And the sector is, of course, still massively struggling following months of weak trade during the so-called golden period. That is the period from October to December that is typically the most lucrative time of year for many retailers. Footfall across UK shops plummeted by 65% last month year on year and was down nearly 1/3 from October. Helen Dickinson, who's chief executive of the BRC, said the run-up to Christmas is a vital time for retailers, with £1 in every £8 spent in December. The government are also trying to help. They're allowing some shops to open for 24 hours over the Christmas period to try and make up for some of those losses experienced over the last few months. So it's a tough time for high street retailers, but fortunately numbers are going up at the moment, and hopefully I think for a lot of them they'll be going up all the way up until Christmas.
It's a brand new week. Brexit talk continues, but what more is on the radar for the week?
Yeah, well, all eyes, as you say, will be on Brexit over the next few hours and days. Also, obviously, the Pfizer vaccine is being rolled out here, the first place in the world to start using a vaccine. And those first doses will go out this week to people in care homes and other vulnerable people. So it'll be interesting to see how the logistics works there. On the business front, Frasers Group has confirmed it is working on a possible last-minute rescue of the famous department store Debenhams. The chain is currently set to shut all of its stores by the end of next March, putting around 12,000 jobs at risk after administrators failed to find a buyer for the business. It'll also be interesting to see how US-China relations change now that we know Joe Biden will replace Donald Trump as president. The US Justice Department is discussing a deal with Huawei Technologies finance chief Meng Wanzhou that would allow her to return home to China from Canada in an exchange for admitting wrongdoing in a criminal case. It'll be really interesting to see how the markets react to any building of diplomatic bridges between China and the US if this does happen. So I think it's going to be interesting to see how that plays out. Also, obviously, looking at Brexit and those Pfizer doses and how well those are rolled out across the UK. And it'll be interesting to see how sort of the markets react to those three big stories that are ongoing.
The vaccine distribution, that's what I want to see. I'm interested to know. Not just me anyway, I'm sure everyone would want to know how the UK manages with that. Thank you, Simon. We expect more updates later in the day.
Thank you. Have a good day.
I'm back here. Eddie, back on the board.
Thank you, Chimio. Dayo Ogundari at Treasury Sales Department of Access Bank will be joining me for this segment. Good morning, Dayo. Thank you for joining us on the program.
Hi, good morning.
Last week, the CBN announced plans to introduce special bills in order to deepen the financial market and deepen investor participation. What are your thoughts on this, and what impact will that have on liquidity in the system?
Okay, good morning. Yes, so I think some of the positives of the special bills is, I think the main one is that it definitely boosts the bank's, helps to boost the bank's liquidity ratio. All the excess CRR that has been sterilized with the CBN will be returned to the banks. Most banks have CRR north of about 40% against the regulatory minimum. So, we see improvement in the bank's liquidity ratio, particularly for the tier 2 banks, and that will go a long way for the banking system.
Now, is this special bill likely to have any impact on the other bills in the market? For example, the treasury bills?
Yes, that's what we expect. We're yet to actually find out what rates those special bills will be offered at. But in the market already, we've been seeing some mixed reactions to the news that's come out. Last week, the trading was mixed sentiments with investors just trying to see what rates the special bills will come out. So I think once the central bank has released those rates, we will then be able to adjust accordingly.
Okay, well, there'll be a primary market auction this week. What are your expectations from that auction?
Well, based on previous stock rates that we've seen close slightly lower in the past couple of weeks, and given the liquidity in the markets as well, and also going to be driven by the additional liquidity we see coming in into the market tomorrow, about 294 billion OMO maturity. I think the rates will close slightly lower. Again, we expect it to be oversubscribed, just given the amount that's on offer versus the amount that's currently in the system as well.
Well, as the year winds... Okay, sorry, continue.
So I was going to say, so I think that will close slightly lower.
Okay, as the year winds down and investors wrap up their, investment activities for the year, what should we be expecting from the bond market, and should we be expecting sizable demand from the December bond auction?
Well, the bond auction is still a week away, December 16th. I think market participants will wait to analyze the market direction, take into account a number of factors, especially where the rates on the special bills close when they are announced, when they are sold into the market by the central bank, and other market sentiments before taking a view on the auction. So I think there's still some factors that are yet to play out ahead of that auction next week. Will determine where the market will go.
One more question before I let you go. What is your outlook for the market this week?
Okay, so this week we still see, just like last week, we still see some mixed sentiments in the market. We think market participants will look to take advantage of some of the select maturities that will become attractive, particularly on the long end of the curve, and also just try and position themselves accordingly after the release of the special bills, then see how the rest of the week will follow on.
All right, Dayo, thank you for your input on the program. Do enjoy the rest of your day.
Thank you so much. You too. Bye-bye.
Dayo Ogundare is in the Treasury Sales Department of Access Bank. Well, that's it on the market review for today, Chime.
Well, the week has just started, and I'm bullish. It's going to be a great week. Thank you. And I'm happy to have you back, Eddie.
I'm happy to be back.
Well, that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwago.